Good morning. I'm Anton Stetner, and today we are going to go through some of my favorite things. We're going to talk about the real estate market. We're going to talk about stats. We're going to talk about home prices. We're going to talk about where the market's headed. I want to make sure I answer all of your questions. So as we're going through this is for you. Hit me up in the chat. Drop your questions about cities or specific areas or neighborhoods or the market in general. And we'll go through the data together. And as always, I want to kind of start with some things that we're seeing here in the media, because I believe this sets the groundwork for where the real estate market is headed. And then why should you listen? I've been selling real estate here since 2003 in the Seattle metro. I've sold thousands of properties here. We own brokerages, title, escrow. We do land development, real estate investments. And I just want to give this knowledge to you because I enjoy looking at this data. And this can help you whether you're a buyer, you're a seller, a real estate agent who wants to interact with their clients and understand better how to have these conversations in relation to real estate. So let's get started with some news that came out this morning. The CPI, the Consumer Price Index, came out this morning. And you can see the Consumer Price Index increased 0.1 for the month, putting the annual inflation rate at 2.4. Excluding food and energy, aka core inflation, came in at 0.1 and 2.8 compared to the forecast. Now, what this really means is it came in weaker than anticipated. To be perfectly honest, I actually thought inflation was going to come out hotter. This is good news that inflation showed up weaker than anticipated. I like also to look at this gentleman on X or Twitter, Nick Timiraos. And he is basically like the Fed whisperer. He works at the Wall Street Journal. He always seems to report the data and then have the ear of the Fed. Why do we care about inflation data right now? We care about inflation data because this is what's setting us up for rates. This is what's changing everything. As inflation data moves, so do interest rates. And we'll get into that next. Okay, let's throw this back up. So core prices rose. The flatness in the year to year, though, overstates how mild this reading is. So inflation is basically beaten. But why is the bond market not responding to this in the way we want? This is what I want to get to. Like, why is the bond market not responding properly? Let's throw up this other piece of data. Okay, so this is the 10-year Treasury. And for those of you that don't know, when you look at the 10-year Treasury, in order to get 30-year fixed debt, all you've got to take is 4.43 and then add 2.5% to it. And that's about what 30-year fixed debt is. Understand that the 10-year Treasury, this is what sets debt and interest rates for everything. Auto loans, student debt, credit card debt, home equity lines of credit, business. As the 10-year moves, so do all of those debts. What's happening is it was trending down. We saw some great interest rates earlier this year. And then this is where we saw that market really light on fire in the beginning of the year as rates got much cheaper and we started to get into the low to mid sixes. Then we had Liberation Day. Then the market shot up, started cooling down again. And then we had the big, beautiful bill and it shot up again. So the thing that I really want everyone to get right now is interest rates are high not because of inflation. Interest rates are high right now because of two things. Because of market uncertainty, and that's a combination of tariffs, geopolitical events, things like that. But I'd say the tariffs are a really big one. Second, the big issue that we're running into is the bond market did not like the big, beautiful bill. There was too much spending involved with it. So what's been happening is rates have been sitting higher. They've been sitting around 7%. And what I want you to get about our local Seattle metro here, the local market, is when rates are above 6.5%, the market cools and slows down. As rates get below 6.5%, the market then starts to speed up and more buyers enter the market. Why? It's just a function of affordability. Our area has very high home prices, so it becomes price sensitive. We are still seeing, though, regardless of these interest rates, bidding wars on the right properties that are in the right locations that are priced correctly or positioned correctly inside of the market. Conversely, we're seeing some properties just sit. Anecdotally, I'm hearing from real estate brokers, both in my office and around the market, that it is a little bit slower right now. And I've got two things I want to go into in relation to the slower. Also, the if you guys have questions, like I said before, just drop them into the chat. I want to throw up this other article. So Redfin came out with this article. This was sent to me like 6 or 7 times. And anytime something starts to really get in front of me multiple times, I see it all over social media, I feel the need to start to answering questions in regards to this. So I'm going to give you a short version of this right now. But if you want a longer, more in-depth version, we recorded a whole podcast about this. You can see that over there on YouTube. But what Redfin was saying, and this is an amazingly clickbait title, the U.S. housing market has nearly 500,000 more sellers than buyers, most on records. That will likely cause home prices to fall. Like, this is a super clickbait title. Come freaking on. When you then dig into the actual data, and this is the graph that was going all over, and it was basically some version of doom porn, and the doomers are all saying the market is crashing. I get this, and people are asking, well, what's happening here in Seattle? The market's still really strong here in Seattle. But when you dig into the data, there's two things that I want you to pay attention to here. One, 259,000 of these sellers are condo sellers. And we know the condo market is disproportionately beat up and being hurt across the US worse than the residential market. So over half are condos. And that's especially true in places like Florida, where they had those natural disasters. And with condos specifically, I don't like condos. And I'm fine with those detached condos that are basically function like a single family. I'm talking about condos that are an attached product or are a stacked product like an apartment. What happens is over long periods of time, the HOA dues constantly increase. And the reason they increase is because property taxes go up, insurance goes up, maintenance goes up, and that decreases the amount of equity that you as a seller get in the property, or as an investor, or as a buyer of these. It makes them harder to qualify for. Redfin goes on to then pontificate later on down over here that they literally believe that it's only going to drop 1%. So you can dig into this more over on YouTube. But why is Redfin doing this? Redfin is doing this specifically because they got bought by Rocket Mortgage. Rocket Mortgage overpaid for them, in my opinion. They paid $1.75 billion. Rocket Mortgage now needs to use this as a lead generation vehicle in order to attract more home buyers, home sellers, refinances, and things of that nature. All right, I want to dig into two more things about our local market before we get into the stats. I do building and development projects, and if you've ever tried to do one here in Seattle, you know that preserving trees is a massively important thing. And then Stanwood also just passed some type of a tree ordinance. This is going to become more and more critical. I am all for the trees. I'm all for air and clean energy. However, I do believe that we have to create a balance here between our housing crisis and clean air. And so what if, instead of things like this, they'd allowed extra trees to be planted or tree credits to be purchased. What we're doing is we're preventing development projects from happening at an economical level. And we're preventing then the first-time home buyer from getting in. My big concern is I'm so pro middle class. I want home ownership to be at the absolute top of the food chain here. Because when home ownership is promoted, we get this strong local middle class, and that helps strong communities, and it helps to keep the economy growing. We can't have just ultra wealthy and the bottom. You need the middle. So who should you know about that's affecting us? This is called the Puget Sound Regional Council. The PSRC is an unelected body of bureaucrats that is currently controlling all of the suburban sprawl in our area. So we just had the opportunity to extend the UGA. The UGA is the urban growth area. That's where density happens in all of these cities. The Puget Sound Regional Council essentially voted to not expand the vast majorities of the UGAs from Thurston County to Whatcom County. So basically up and down the I-5 corridor. We currently only cover, and I can't remember the number, it's either 2% or 4% of Washington State with homes. And so we're clustering them all on top of each other. I don't want to see everything be an apartment or a townhome in the future. And by the PSRC voting to not bring in more buildable land inventory, aka land inside the UGA, what they have essentially said is they want to force density and force home price appreciation, which is good for us as investors long term, but hurts the middle class and that first-time home buyer. Okay, push on politics locally for this. I do in my area, and I really want you to get involved too. All right, let's dig into the data. Molly, Arlington's a little slower right now. Inventory is up. And I think this is actually a reflection of the whole market showing, really what's happening. Inventory is slightly up everywhere, but the media makes it sound like the Seattle metro is massively slowing down, when nationally there are areas where you're seeing some price declines. So are the top 50 metros, there are 4 metros right now that are showing some type of price decline between 1 to 3%. And when you think about that, even 3% on a $500,000 house is almost nothing. That's 15 grand. And 1% would be $5,000. That's really not that big of a deal, but the media likes to overscare the general public. And that's why I want to give you the actual data. I want to give you the facts of what's happening. If you guys have questions or comments, drop them into the chat so we can go through it. Otherwise, what I'll do is I'll just keep going through this data for you. Okay, so let's go look at King County. So King County specifically. And as I'm looking at the data here in King County, what I like to do is I like to look at it on a monthly basis. Because when we look at it on a monthly basis, we can see each one of the data points and you see the nuances. So you can see right now that the median price is basically was $876 in May of 2022. And so we passed that in April, and then we're above that in May in 2025. So the median price, we're above that now for King County. I'll tell you the rest of the counties are not above the peak of 2022 yet. So not to be a spoiler, but that's where the data currently sits. Down 2.3%, and the average is down 2.8. Now, these are month-on-month numbers, and as we're done with the month-on-month numbers, we will look specifically at the year-to-date numbers. But I want to go through like the raw data versions first. New listings. So new listings are up 24%. Okay. Last month in May, there were basically almost 5,200 listings. But when you zoom out and we go to 5 years, we go, you know what? That's barely above 2022, barely above 2020. Well, let's look at it over 10 years. You know what? We got to go back to 2019, and then we're at 5,500. So now let's smooth the data out. Oh, interesting. See, when you look at this on a 12-month, rolling average, we're still below where we were before. But that doesn't make for a good headline. The media wants to be like, oh, inventory is up 24%, the sky is falling, but it's still down based on the historical levels here in the Seattle metro. Homes for sale, up 32%. Pendings, actually, let's go back to the raw data. I like looking at the raw data. Let's shrink it back down 3 years. Pendings up 11%. Wait a second. I thought the market was slowing down. Closed sales, down a little bit. So pendings up, closed sales down. That's a little bit of a lag there. So closed sales may then end up trending up in relation to this, and we may start to catch back up. Days on market. Days on market is 23. Also, what's happening here is, I got to tell you, and I'm not trying to be rude about this, I'm just trying to be really real. This is the inexperience of agents inside the real estate market. What they're doing is we're freaking out a little bit because we're assuming, because days on market is up 27% and it's up to 23 days, that the market is now massively slowing and changing. This is returning a little bit more towards a more normal market. For the agents who have only been in the last few years or since, COVID, they assume that everything should sell in 10 days. That's not normal. Around a month is very normal. So we're still in a seller's market, even though it feels like we're sliding into a buyer's market. For those of you that were with us during the great financial crisis and days on market, actually, let's just look. Let's go into King County. I'm going to go look at days on market. I'm going to show this just for perspective. I'm going to smooth the data out too. So look at this. In 2009, the average days on market was 80. And then we start to look at this, and you can see by 2016, look at that 30 bar. That 30 bar is right where my mouse is going across. 30's right there. Oh, Molly, you just said this so well. You got to set clear expectations with the seller so they are informed. If you're the listing broker, if you're an investor, you got to do some research on this data yourself so you can set clear expectations. This is normal. I mean, you are absolutely nailing it. This is more of a normal market. The market is returning to normal. Month supply of pending with the data smoothed out is up 31%. So supply is up. So they say, oh, it's jumping, it's exploding. But really what's happening is this is that return to normal. And I'm going to look at the data monthly. So right now, King County is at about 3.5 months. Below 5 months is still a seller's market. Above 5 months, you're starting to get into a buyer's market. Michael, I 100% agree. When I got into real estate 9 years ago, it was normal for a house to sell in 4 to 6 months. It's still not there. That is 1,000% so true. What was also interesting, even during the great financial crisis, is homes would be sitting on the market, but all of a sudden, when there was 14 months worth of inventory, if it was priced correctly, you still saw bidding wars even then. So as inventory rises for the right property in the right school district in the right neighborhood, you'll see bidding wars. And this is all we're doing is starting to slowly return to normal. What I want you to get, though, is this. Let me throw the data up. This rise right here is actually the showing to you a buying opportunity. What's crazy about buyers and investors is they say, I want to wait for the right time in the market. I will tell you, this is one of those right times because I'm currently betting my own money. And I know a lot of people are betting their money, and Wall Street is betting their money, that the Federal Reserve is going to have to lower interest rates and that we are going to get these rates down from their about 7%. Well, what's going to happen to the Seattle Metro? Hey, everyone in the chat. Seriously, what's going to happen to the Seattle Metro when rates go back to 6, 5.5, 5.75? I'm going to tell you the market's going to light on freaking fire. And there's going to be absolute bidding wars everywhere. And so when people say, I want a deal or when is the right time, right now is one of those right times. Also, because the kids are getting out of school, this is generally one of those low spots. And then next week, what happens is we kind of get the what is it called? The pre-4th of July rush. Of course, it's dead around the 4th of July. For my hardcore investors, I'm looking at you, pointing at the camera right there. This is when we make offers. We make offers right around the 4th of July while all the agents are out of the office, while there's not as many buyers making offers. And I agree with you, Molly. It's going to light on fire, fire, fire. So the Federal Reserve was just talking about how they're not ready to cut rates. But this new inflation data that just came out, this inflation data starts to give them cover for cutting rates. The cover now makes the likelihood, and you can go look at this at what's called the CME Fed Watch tool. I looked this morning. The odds of a rate cut in September are now going up. So I would say we're closer to rate cuts than further. What's it going to take? Honestly, it's going to take getting more tariff deals. Once we get the tariff deals and the inflation continues to cool, you're going to see more rates trend down. This is a piece of data I always want you looking at. It's called the percent of original list price. The percent of original list price is how you know when bidding wars are happening. I exported this data one time and I dropped it into ChatGPT. And with the data, I said, what is the historical norm for the Seattle Metro in the list to sales price ratio? And this is for the percent of original list price. In other words, if the property was on the market for 100 grand and it sold for 98, this number would show 98% of the original list price. You can see it's showing 99.6. This is above the historical average. That means bidding wars are still happening. You can see, though, it already peaked in April. Interesting. When does it usually peak? April, May. Oh, there's in May. There's back in 2022, right before they raised rates. And then, boom, it crashes right after that. So the thing to understand is, when's the best time of the year to buy? Well, look at that. It's in the winter. It's always in the winter. Why? Because it's gray and gloomy here in the Seattle Metro. That's when you're getting the best deals. So what I say to my investors, the people that are my homies that we're making money with, is we always want to make offers in the fourth quarter. We want to be picking up projects in the fourth quarter that we're then going to sell in early spring, late spring, and early summer. That's when all the appreciation in the market happens. You can always see that in the sales price data. So let's throw that up so I can show you the example. So look, the market peaked, came down a little bit in April. July, all that appreciation happened. Actually, let's take it off at 12 months. Oh, look at that. Market goes up, peaked in April. Market goes up, peaked, that's August, that's an anomaly. Peaked in July, peaked in May. But as you can see, generally speaking, in the Seattle Metro, we get all of our appreciation in the first 4, 5, 6 months of the year. All right, let's look at King County on the rolling 12. This is just basically pulling the fast stats. I like looking at the rolling 12 because it gives an indication of where the market is going. Once again, if you guys want me to look at something specific, hit that in the chat and we will chat about it. The median sales price is up 1.6 for King County, and the average sales price is only up 0.3. I cannot freaking believe that the average sales price for King County is 1.25 million. That is so freaking high. New listings up 18%. Pending sales down 0.9. So I'm looking at this year-to-date data right here. Days on market, really about the same as it was last year. And then Molly had brought up the fact that she believes it's part of the condo market is slowing in Seattle. I agree. The condo market is slowing in Seattle. It's also slowing throughout the U.S. But when you look at this condo data for King County, which is literally right here, I'm going to have to hide your comment. You can see, I mean, it's currently outpacing residential, up 6.9% on the median price and up 7.1 on the average. And remember, average is you add them all together and divide by the total. And median is the middle. So median is less volatile. It's less susceptible to the ups and the downs. That's a more, easy rolling number. All right, let's go look at Pierce County real quick. We're going to look at Pierce, then we're going to look at King, and then I will look at any piece of data that you guys want me to take a peek at. Let's make me smaller. Average price in Pierce County up 4.4% versus last year, 618. We peaked at 617 in 2024. And we are above the 2022 numbers. Median 560 and 569. Pierce County is above the 22 numbers. Yep, Kelly, we're going to go to Snohomish County right after this, brother man. And so as soon as we're done with Pierce, new listings, up 13%. Homes for sale up 25, similar to King. Pendings up 8.3%. Closed sales down 4.5%. Days on market 29. Month supply of pending. There's less supply in Pierce County than there is in King County. Let's go to the percent of original list price. 98.8, so pretty normal. Showings to pending, 11. Showings per listing, 4.5. If you're an agent, I always want you to look at that one. Showings to pending and showings per listing. That metric is what you should be talking with your sellers about for price reductions, assuming you are priced correctly, assuming you are presented well inside of the market and positioned correctly inside the market, and that your condition is good. If you are all of those and you only got, in this example, 4.5 showings, then the market is telling you you are overpriced. You can take this data and you can drill down into a zip code, you can drill down into a neighborhood, but that's how you ask for the price reductions. And Kelly, let's go do Snohomish County. That's where we were going next. Let's go to Snohomish County. What's happening there? Let's go to the sales price. Let's look at the median. We're going to hide you. We're going to make me small. Okay, median 775 in May of 2022. We did pass there too. Look at that, 780, up 4% versus last year. Average price up 2.8. The thing I want you to get about this data for Snohomish County is more affordable than King County. It's also more desirable than Pierce County. So those buyers are moving out of King up into Snohomish, which is causing more buyer activity, which is causing these prices to rise. And what do you think is going to happen when the Federal Reserve lowers rates? Where is this going? Throw the slides back up. New listings. Interesting. New listings up only 17% versus, the 24 in King County. Homes for sale. That's a big jump. Up 49%. So May, about 2,100. Let's go to May of last year. It was 1,400. Okay. Let's go to 23. 1,100. Interesting. Very interesting. So definitely more for sale. Pendings up 6.6, not down like King County. Closed sales down 6.3. There we go. That matches. Days on market 20. Okay, a little less in King County. Once again, that's probably an example of affordability. Let's go to month supply of pending. 2.5. And once again, getting up a little bit, but look at it over a longer period of time. I mean, this is very normal when you look at 20, you go back over the next decade. This is just normal. But the media likes to try to scare us. Okay, so always remember that. Percent of original list price, one of my favorite numbers. Average, let's get rid of all this stuff. 3 years, 99.1. Still pretty hot. And shows per pending, 10. Shows per listing, 5. So that same script applies. Yeah, let's go a little further out. Let's go look at good old Kitsap County. Why not? Kitsap County, what's happening there? Sales price, median. Got to hide you so we can see the full graph. Kitsap peaked in June of 2022 at 585 on the median. And then we're at 575 on the median, up 2% month on month when you compare May versus May. So really almost back. Average, basically 674, up 4.3%. And still slightly under. What I would say with this one, just in a quick look at it, this is also another example of affordability. As you leave that kind of average being $1 million, like in King County, or 1.25, these more affordable areas are showing more appreciation than the less affordable areas. And if the PSRC would give us more buildable land, we could actually keep the appreciation lower. See, I don't want rapid appreciation. I want that strong middle class. All right. New listings up 1.9%. Really about the same. That's not surprising, though, because Kitsap is definitely a smaller market. So the thing about these smaller markets is they don't move as much as the bigger ones because there's not as much activity and population in those areas. Remember, Seattle and Bellevue are the two centers of our real estate universe. And then every ring after that becomes a secondary market, a tertiary market, things like that. So your secondary market from Seattle, of course, is going to be Snohomish County. Your tertiary market from that is going to be somewhere like Salton, Gold Bar, Camano Island, the outskirts of Maple Valley, Black Diamond, parts of Pierce County. These outer rings won't get affected as much. But what you can also see, if the market is crashing, because we saw this last time when the market started to crash, is those outer rings during the great financial crisis started getting hit first, and it started collapsing in on the motherships, Seattle and Bellevue. Homes for sale up 8.4% month on month. Pending sales down 1.5%. Closed sales down 3.1%. Days on market 32. Month supply of pending 3. Honestly, it's a pretty good market out there. High average list price, shows to pending 9, shows per listing 4.5. Feels really good. I want to also look at, because we didn't look at this. This is the Pierce County one, just on the rolling 12. So you can see the median price up 3.2, and the average up 3.6. I also want to look at the Snohomish County one. Up 2.6, up 3.9. Definitely, that's not a crash. That is still appreciation in the face of 7% appreciation. So the thing I want you to be thinking about, and as you're an investor or a buyer or an agent, is if Snohomish County, for example, the average price is appreciated already 4% this year in the face of 7% interest rates. What will happen when rates go down? For the buyer that says, I want to wait, this is probably going to end, let's just call it 5% to make the math simple. And I got to open up my magic calculator here. So you take 892,000 times 0.05. 892,000 times 0.05 is 44,600. That means for the average buyer that says, I want to wait until 2026, they will pay 44,600 more in 2026 than they did in 2025. And because the economy is not perfect right now, with the economy being slightly weak and interest rates being really high, if this is the appreciation, what happens when they lower rates? Ask yourself what central banks have already cut rates? Look, other people have already asked this question. I kind of like how they throw these, Gemini results up, how AI is getting integrated into this search. But look at this. Several major central banks have already cut rates, including the European Central Bank, the Bank of England, the Swiss National Bank, the Bank of Canada. Other central banks, like those in Sweden and Norway, are expected to follow suit. Now, of course, with AI, we all know you got to take it with a grain of salt. You got to go check those results. But the moral of the story is the world has already started lowering rates. Therefore, the U.S. is most likely not that far behind. And we would already be in a rate cutting cycle if it wasn't for these tariffs. So I got to make a bias clear. As I'm sharing data with you or having these discussions, I always want to be clear about my biases. I'm anti-tariff. And because we've already gone so far down the path, I believe tariffs can be a good tool. I believe our methodology of implementing them has not been the best. And so I am 60% anti-tariff, 40% positive. But what the tariffs have done is they have brought uncertainty into the bond market. And then the big, beautiful bill with additional spending has brought uncertainty. If we didn't have that, the Federal Reserve would actually most likely already be lowering rates. So what happened was these tariffs delayed the rate lowering, which is delaying the appreciation here in the Seattle metro. And oh, yeah, thanks for that, Kelly. So the European Feds have lowered their rates 9 times. I didn't know that. That's crazy. But it makes sense because our tariffs are causing us to pause. The other thing I want us to get about like the big, beautiful bill and things like this is we have to get our spending under control. If the U.S. does not get our spending under control, because we're currently over $36 trillion in debt, what will happen is the cheap interest rates that you and I enjoy, that all the consumers here in the United States enjoy, that drive our consumer-based economy will go away. And that's going to hurt small business. That's going to hurt consumers. That's going to hurt the economy. Our politicians need to get this spending under control. This isn't a Republican issue, a Democrat issue, a Libertarian issue, a pink fluffy freaking unicorn party issue. This is a crisis. We have to stop spending so that the bond market will literally chill out and these rates will come down. See, the bond vigilantes are what's keeping this higher. And Moody's downgrading our debt is what's keeping our rates higher. Why? Because we're spending too much. Does anyone have anything else that they want to go through or any other pieces of data that they want to look at specifically? I've got listings in Everett that are my own personal ones. So I'm going to start to look at Everett real quick. We just built some dadoos. And if you don't know, I think the detached accessory dwelling unit is the absolute best thing that you can do to make some money in today's market. So let's look at Everett. Everett peaked at 708 on the average. We got to 862, 664, down 2.4. New listings up 12%. Homes for sale, ooh, look at that, up 55%, but really still not that many. Kelly, 61% of homeowners in Washington State have a mortgage interest rate under 4%. Second in the nation behind California. Exactly. And what's interesting about that is that's that lock-in effect. I read data, Kelly, that said 80% of all mortgages essentially are like below 4.5%. In the great financial crisis, your mortgage was a liability. It was a liability because of the ninja, no income, no job, no verification loans. The liar loans, for conversation's sake. What happened was over 50% of the market at that time was an ARM. And those ARMs all started resetting as rates came. So that started squishing people's purchasing power because their payments went from $2,100 to $3,000. Or I saw one that went from $2,200 to $4,500 because the ARM had reset. Today, with 80% of them having a fixed debt, and their debt, because appreciation has happened so much, with the debt being less than renting, there's no way we're going to see all of these things happen. Dave, excuse me. June, month-to-month date. Look at King County is down 40% and Penning's up almost 30. Curious if the rush to list after Liberation Day. Yes. Oh, that's a really good point. Yeah, what happens a lot of the time is, when we get that fear in the market, fear causes things to happen. And I know this happened to me and it happened to a few of my other friends, Dave, was, we get buyers and investors that are in the tech space. And when their portfolios go down, they stop spending very quickly because their net worth is being attacked. So we could have seen that bump as like, oh my goodness, a pre-front load to what's happening. Also, what's interesting about consumers just in general is consumers in general can only wait for like 6 months, 9 months before they start making a decision. So they'll sit on their hands and wait with this bad data. But if you think about that, if Liberation Day was in April, that still means that the latter part of the year, even if this trade stuff is not solved by then, you could start to see a bump in September, October, or maybe even the beginning of 2026 by people who have now decided, regardless of what's happening, I'm tired of sitting on my hands. I'm going to push forward. Also, what's interesting about the stock market, because I look at my portfolio, we're basically almost right back to where we were. This is a lot to be said about financing in general or investing in general. The stock market just had literally a V-shaped recovery. It went down because of the external inputs and then literally just boom, popped right back up. In the great financial crisis, as prices were dropping, I told multiple people, do not sell your home, rent it out. And they're like, I'm so far underwater. I was like, mathematically speaking, we are below replacement cost. And what that means is it means I can't build it for what we would sell it for, which means we have to come back up. It has to shoot back up. Just sell it. And I owned a bunch of rentals at that time, and I was way underwater. I was negative, way 7 digits, and owed everyone a bunch of money. But because we didn't sell, we got that recovery. So the cool thing that just happened with the stock market lately is that my son is 19, and I've got him pulling a little portion of his paycheck every 2 weeks and shoving it into the S&P 500, into one of those ETFs that mirrors the S&P 500. I think it's the Vanguard one, VU, not financial advice. And so he got to see the ride down. And he goes, what do we do? I said, well, we just buy more. We're long-term investors. We don't care if the market's moving up, down, or sideways. We don't care about these blips in price. We don't react emotionally to it. All we do is we keep buying and keep investing because we know over the long run, so let's go back to King County. Excuse me. Over the long run, and I'm going to smooth the data out, and I'm going to go to the max. Look at this. I'm going to drop myself all the way off the screen. Over the long run, this price in January 2006 was 408,000 average. It peaked at almost 500. It got as low as 380, and it's basically up to 1.1. So if we don't react emotionally, prices are basically just up and to the right. I'm going to bring these guys up again. Oh, and what's preventing that? The buildable land inventory. What else is preventing it? Red tape. I've been doing land development projects and been involved with builders and stuff like that since 2003. I can tell you in over 20 years, all it's done is get harder, more regulation, cost more money, and take longer. This housing crisis in Washington is going to 100% absolutely continue. And that lack of supply is going to continue to force up housing prices. Anyone else have any questions or comments or things that they want to chat about? The pending sales. So smooth data up 5%. Let's unsmooth the data and this is King County again. Up 11. Closed sales still down. Let's smooth it. Up 4.6%. Look at that. When rates, I mean, literally you can see rates come in and just smash that right there. I do believe it's going to take a while before we get back to that kind of run rate of 6 million. So in closing, one, thank you for hanging out with me. All of you are freaking awesome. If you're on good old YouTube, hit that subscribe button. If you guys got questions or comments, drop them into the chats. If I don't get them to you now, I will come back and do my best to answer each one of them. But in summary, yes, rates are still around 7%. Yes, there are some buying opportunities right now. Yes, there are bidding wars still happening. Yes, it is actually still a good time to list. I will tell you, though, in August, it's going to slow down. It does every August. I will tell you anything that you can do to buy or build new construction. Yeah, thank you, Blake. Thank you for hanging out. And I love what the text message you sent me the other day, brother. I love that just happened by you getting out there. And we know that inventory, even though it's rising, it's not dramatically rising here in the Seattle Metro. Why? Because of the lock-in effect. Because of the lack of supply. Our foreclosure rate in this state is still at an all-time low right now. It's unbelievably low. And therefore, no one's coming to save us on the inventory front. Therefore, you and I should be out there building these ADUs, these DADUs, creating units, creating that opportunity. Kelly had a question. With the growth management committee, did they already go? Yes, they did. You're correct, sir. So they did the comprehensive plan and they move it out. It's like 5-10. So the next one is already set in place. And now they don't meet, I believe, for another 4 years. Just absolutely crazy that we've got to wait that long to possibly get more inventory in. Also, I will tell you that Mike Appleby is our citizens rep there at Chicago Title in Snohomish County on the PSRC. He knows this better than I do if you have specific questions. All right. Thank you, everyone. You're awesome. Have an amazing day and drop your questions and hit that magic subscribe button. Thank you.